60 seconds to the top of the hour. We've got futures holding this really cautious green right now.
Barely green, honestly.
Right, barely. The U.S. 10-year Treasury is sitting at 4.67%. And, well, all eyes are on the BLS data dropping at 8:30 a.m.
It is the single biggest morning of the month for the markets. I mean, after a totally chaotic week of tech turbulence, every trading desk is just desperate for a Goldilocks jobs number.
Not too hot, not too cold.
Exactly. Not too hot to spark inflation fears, but not too cold to trigger a panic about a hard landing.
Well, looking at the board, I'm seeing the S&P 500 futures trying to hold on. They're up like 0.02%.
Flat. Effectively flat.
Yeah, practically frozen. The NASDAQ is up 0.20%, just clawing back yesterday's losses. And the Dow is lagging a bit, down 0.12%.
Nobody wants to make a move.
Right. It is Friday, August 7, 2026. You are tuned into the Bulls, Bears, and the Bell podcast, and our deep dive into today's market action starts right now.
And we have a massive amount of ground to cover before the opening bell.
We really do. I mean, we're 60 minutes out from arguably the most pivotal pre-market session of the summer. For you listening, whether you're managing a massive portfolio or just trying to figure out where the global economy is actually heading, we're decoding a morning full of violent contradictions.
Very violent. The overarching theme in the data today is capital defensiveness.
Capital defensiveness. Okay, let's unpack that. Because on the surface, it looks like total chaos, right? You've got specific stocks spiking while the rest of the market is completely paralyzed.
Right, but it's not chaos. It's actually highly sophisticated money trying to find a safe harbor. The macroeconomic data, the overnight corporate earnings, geopolitics, they're all colliding this morning.
And investors are ruthlessly picking winners and losers in real time.
Exactly, which is why the market breadth is thinning out so dramatically. If you look under the hood of that S&P 500 number, fewer and fewer companies are actually participating in the rally.
People are just pulling their capital out of the broader market.
Yeah, they're terrified of what happens at 8:30 a.m. Eastern. They're concentrating cash into a very small cluster of safe havens.
So let's talk about that 8:30 a.m. standoff, the July non-farm payrolls. The consensus estimate right now expects 83,000 to 85,000 jobs added.
Which is a decent jump from the 57,000 we saw in June.
Right, with unemployment projected to hold steady at 4.2%. But if you're holding index funds this morning, you are flying blind into this data.
Totally blind. And that 10-year yield creeping up to 4.67%, that is a real-time fear gauge.
The bond market is heavily pricing in anxiety.
Oh, absolutely. It's signaling a deep fear of this higher for longer interest rate environment. The market is walking a very narrow tightrope today.
Because if the jobs number comes in way higher than 85,000, that signals a really robust labor market, which sounds great for the average person, right?
You'd think so, yes. But in this specific macro environment, strong employment means consumers have more disposable income.
Which keeps demand high.
Right. And sustained high demand keeps inflation elevated.
So if we get a high print, the whole good news is bad news, trade activates instantly, the Federal Reserve has to keep its foot on the brake.
It forces their hand. And you know what makes this even more tense?
St. Louis Fed President Alberto Musalem.
Exactly. He is speaking tonight at 9:30 p.m.
And he's got a well-known hawkish tilt.
Very hawkish. So the entire market knows that if the morning data runs hot, Musalem could easily use his platform tonight to signal a September rate hike.
Wow, which just raises the cost of capital for every single business in the country. It's like putting a massive weight on a coiled spring.
Right. But on the flip side, if the jobs number is a huge miss, say down to 40,000 deal.
Then the market completely panics about a hard landing and a recession.
Exactly. Huge miss equals recession panic. Huge beat equals rate hike panic. There is virtually no margin for error today.
Which perfectly explains that capital defensiveness you mentioned. When there's zero margin of safety, institutional money stops betting on the broader economy.
They hunt for cash flow. They look for companies that can generate cash regardless of what the Fed does.
And that ruthlessness is why we are seeing these insane independent gravity wells forming in the tech sector this morning. I want to run through the pre-market bulls because these numbers are wild.
They really are.
Doximity, ticker DOCS, is up 70.1% on a massive earnings beat and upward guidance revision.
70% overnight. Just incredible.
Cloudflare, ticker NET, is up 16.0% Atlassian, ticker TEAM, is gapping up 30.1%.
There is a very clear pattern here. These are all enterprise software and software as a service companies.
Right. They aren't building ships.
No, they're not hardware manufacturers, and they aren't consumer discretionary brands. They are B2B platforms with high-margin recurring revenue.
Which is fascinating because earlier this week, semiconductor and chip stocks were getting hammered. We saw Datadog, ticker DDOG, down over 5% recently, just in sympathy with the semi space.
Right. The AI hardware trade has been highly volatile.
So are we witnessing a fundamental rotation here? Like, is Wall Street basically saying, okay, we're done buying the AI infrastructure, show me the companies actually using the AI to make money?
That is exactly what's happening. We are firmly entering the show me the ROI phase of the artificial intelligence boom.
The harvest phase.
Yes. For the past 2 years, the market blindly threw capital at the builders, right? The semiconductor manufacturers, the data centers.
The assumption was whoever builds the infrastructure wins everything.
Exactly. But hardware is incredibly capital intensive. And those chips, they're depreciating assets at the end of the day. Investors are now demanding monetization.
So they're rewarding software companies that use AI to lower costs and increase subscription pricing power.
Right. They don't want to fund the construction of the toll road anymore. They just want to own the toll booths collecting the cash.
That toll booth analogy perfectly explains Doximity jumping 70%. I mean, medical networking software is highly insulated from macro shocks.
Doctors still have to communicate. Hospitals still have to manage workflows.
Right, whether the Fed hikes rates or not. So when they revise guidance upward in this terrifying environment, capital just floods in because it represents certainty.
Certainty is the most valuable currency on Wall Street right now.
Which also explains the brutal divergence we're seeing in ad tech today.
Oh, that sector is a bloodbath of contradictions right now.
Seriously. The data shows PubMatic, ticker PUBM, is up 30.6% after an amazing quarter. But in the exact same sector, the Trade Desk, ticker TTD, is down 27.3%.
It's ruthless.
And then DraftKings, ticker DKNG, is dipping 3% after missing revenue estimates. So if capital is fleeing to software, why is the Trade Desk getting completely decimated?
Because in a market starved for certainty, any weakness in forward guidance is a death sentence.
Just zero forgiveness.
Zero. PubMatic delivered flawless execution. But the Trade Desk showed a slight vulnerability in their outlook.
And when the 10-year yield is at 4.67%.
The risk-free rate of return is just too competitive. Investors will not tolerate execution risk in a high-multiple tech stock right now. If growth might decelerate even a little, the capital rotates out instantly.
Wow. You either deliver bulletproof revenue or you get cut in half. And it's not just tech. The biotech bears are out today, too. CVRx, ticker CVRx, is plummeting 41.3% on regulatory setbacks.
Classic binary risk in medical devices. You live and die by the FDA.
Exactly. But on a brighter note for the consumer, Airbnb, ticker ABNB, is up 8.5% on a top and bottom line beat.
Which is a huge signal.
It tells me the upper middle class consumer is still traveling, still spending, despite all the inflation fears.
Right. But remember, that feeds right back into the anxiety over the 8:30 a.m. jobs report.
Oh, because strong travel demand means strong consumer demand overall.
Exactly. If Airbnb is beating earnings, it gives Alberto Musalem and the inflation hawks all the ammunition they need to argue against rate cuts.
Good news is bad news strikes again. And, you know, this U.S. tech and software optimism doesn't exist in a vacuum. It is actively colliding with global fragility and some severe energy threats abroad.
The international picture this morning is a masterclass in conflicting forces.
It really is. The regional data is highly fractured. Looking at the Asia-Pacific region, China's Shanghai Composite is up 1% on 24% export growth.
Which is solid, but then you look at Japan.
Right. The Nikkei 225 is down 0.9% on yen intervention fears, and South Korea's Kospi is facing its 7th consecutive down week, dropping 0.8%.
And Europe is trying to walk a tightrope.
The Stoxx 600 is up 0.2%, so they're trading near record levels. But they are balancing this against a massive looming threat in the Persian Gulf.
The situation in the Strait of Hormuz is the phantom menace of today's market session.
Yeah.
It is literally the physical ceiling on global growth right now.
Let's break down the mechanics of this energy shock, because the numbers are alarming. WTI crude is surging to $78.33. Brent crude is up to $83.71.
And gold is hovering at an astonishing $4,230 $40 an ounce.
4 grand. I mean, the ultimate physical safe haven. And the catalyst here is this geopolitical wildcard. We have conflicting rumors of a shipping lane deal between Iran and Oman, weighed against reports of new Houthi attacks.
But the biggest red flag in all our sources today is that draft bill from Iran.
Right, threatening to fine hostile vessels 20% of their cargo just to pass through the strait.
We really need to look at how maritime risk models function to understand why oil is spiking on this news.
Okay, break that down for us.
Well, the Strait of Hormuz is the most critical energy choke point on the planet. Millions of barrels pass through there every single day. A shipping company cannot simply absorb a 20% cargo fine into their operating margins.
That would wipe out their profits entirely.
Exactly. And frankly, maritime actuaries cannot accurately price the insurance premiums for vessels entering a zone with that level of arbitrary threat.
So the shipping companies just refuse to enter the strait.
Right. They are forced to reroute all the way around the Cape of Good Hope.
Oh, wow. And rerouting a massive oil tanker adds, what, 14 to 20 days to the voyage?
At least. And that creates a cascading logistical nightmare. You are burning significantly more bunker fuel, you're tying up a global shipping capacity, which creates a shortage of available vessels.
Which in turn causes daily freight rates to skyrocket across the board.
Exactly. The cost of physically moving the energy from the producer to the consumer multiplies exponentially.
Yeah, so if maritime insurance and freight rates spike because of this 20% fine, that completely offsets any domestic monetary policy.
Yes.
The inflation is coming directly from the supply chain, not the U.S. labor market.
And that is the exact nightmare scenario for the Federal Reserve.
Because oil is a foundational input for the entire physical economy.
It dictates the cost of manufacturing plastics, the cost of flying cargo planes, delivering groceries to the local supermarket, everything.
And the Fed is aggressively trying to manage demand by hiking interest rates, but they have absolutely no control over the global supply side.
They can't print oil, and they can't negotiate maritime treaties.
So if geopolitical tensions keep a hard floor under crude oil prices, headline inflation is just going to remain sticky.
Precisely. Alberto Musalem knows that a supply-side energy shock bleeds into every sector of the economy.
Which is why the bond market is pricing the 10-year yield at 4.67%.
The geopolitical reality in the Middle East might literally force the Fed to maintain high interest rates purely to suppress demand enough to balance out that massive surge in supply chain costs.
It is incredible how a draft bill in the Middle East directly threatens the valuation of every company in the S&P 500 by forcing the Fed's hand.
It's all connected.
It really is. But, while the entire financial world is obsessing over the Middle East and this 8:30 a.m. jobs print, a massive domestic policy shift just slipped completely under the radar in Washington.
It's arguably one of the most consequential structural shifts in domestic finance since 2018.
And it is happening entirely in the background. The research highlights that the House just passed H.R. 6955.
A sweeping legislative bill designed to ease capital requirements for banks.
Right. And to be crystal clear for you listening, we are strictly impartial on this. We're purely looking at the market mechanics of this legislation, not endorsing either the regulation or deregulation of the banking sector.
Absolutely. But the market implications of this are massive.
Huge, because lowering capital requirements essentially reduces the amount of cash and high-quality liquid assets a bank is legally required to hold in reserve, right?
Right. We have to look at how Tier 1 capital functions to see the shadow stimulus effect of this bill.
The shadow stimulus, I like that.
Well, a bank's capital reserve is its buffer against systemic shocks. It ensures they remain solvent if a large percentage of their loans default.
Makes sense.
So by passing H.R. 6955 and intentionally lowering that required buffer, lawmakers are allowing banks to unfreeze billions of dollars in dormant capital.
They are intentionally injecting liquidity into the credit markets. It almost feels like they're creating a synthetic rate cut to front-run any potential recession data we might see at 8:30.
It functions exactly like a synthetic rate cut. If a regional bank is suddenly allowed to hold 8% in reserve instead of 10%, that 2% difference represents billions of dollars that can now be deployed.
And banks deploy cash by issuing mortgages, funding corporate expansions, and providing small business loans.
Exactly. It stimulates economic velocity without the Federal Reserve ever having to touch the official interest rate.
But wait, deregulating bank reserves right before a potential recession? Isn't that a bit like removing the crumple zones on a car to make it lighter?
It's a great analogy.
I mean, yes, you get better gas mileage right now, and maybe it helps you accelerate out of an economic slump. But if you hit a wall at 8:30 a.m. with a catastrophic jobs report and loan defaults start piling up, the impact to the driver of the regional banking system is going to be devastating.
That is the exact tension institutional risk managers are debating this morning. It alters the fundamental risk model for the entire financial sector.
So it's a double-edged sword.
Very much so.
Mm-hmm.
On one hand, this bill provides a massive profitability catalyst for regional banks, which is why you might see a violent rotation of capital into financial stocks if this gains traction in the Senate.
Because they can lend more and earn more interest?
Right. But on the other hand, it actively amplifies systemic fragility. If the economy experiences a hard landing, these banks will have a significantly smaller safety net to absorb the losses.
Which drastically increases the risk of bank runs and localized failures. It's a high-wire balancing act, and it proves that the market isn't just reacting to data today, it's reacting to the changing rules of the game itself.
It's all moving so fast.
It really is. Well, we have covered an immense amount of ground to get you prepped for this morning's session. We broke down the paralysis in the broader indices and how the 10-year yield is pricing in this high-stakes 8:30 a.m. jobs print.
The standoff is almost over.
Almost. We also explored that show me the ROI phase of AI, explaining how capital is fleeing hardware and flooding into enterprise software companies like Doximity and Atlassian for safety.
The flight to recurring revenue.
Yep. And we mapped out how a 20% cargo fine in the Strait of Hormuz effectively handcuffs the Federal Reserve by spiking supply chain inflation.
Total logistical nightmare.
And finally, we uncovered the shadow stimulus mechanics of the HR 6955 banking deregulation bill. Every single piece of this puzzle connects back to capital defensively, seeking certainty in an uncertain world.
It really does. But, when you look at all these data points together, a very profound structural divergence emerges.
I know you always have a final thought you're chewing on before the bell. What is the lingering question you're leaving us with today?
As you watch the tickers cross your screen today, ponder this. We're watching digital software companies experience 30 to 70% explosive gains overnight, entirely driven by code, recurring subscriptions, and algorithmic efficiency.
Right.
Meanwhile, the broader indices and traditional sectors are completely paralyzed, weighed down by the physical realities of shipping lanes, maritime insurance, and interest rates governed by physical labor markets.
Wow, yeah.
Are we rapidly approaching an era where the digital economy completely decouples from the physical economy? Can the digital world continue to soar into the stratosphere, totally insulated from the gravity and conflict that restrains the physical world?
That is a phenomenal question. I mean, if the global supply chain fractures or if the labor market cracks, which economy actually feels the storm? Does the software sector even notice, or do they just keep revising their guidance upward while the physical world burns?
It's something every investor needs to ask themselves.
It is a fascinating dynamic to keep in the back of your mind as you navigate this market. Well, thank you so much for joining us on this deep dive. Don't forget to subscribe on Spotify or your favorite podcast app so you never miss an episode. Stay sharp, stay curious, and we will catch you on the next one here on the Bulls, Bears, and the Bell podcast.